the best of Money Matters.
Market View on Money FM 89.3.
You're listening to Money FM 89.3, and it's now time for Market View, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors, and companies to watch to help you better position your portfolios. I'm Alexandra Parada. First, let's take a quick recap of how the STI closed for the day. At the close, the STI closed down at 0.3% at 3,915 points. In terms of sectors to watch, the REITs and real estate space is facing pressure with recent earnings, showing weaker rental income and lower distribution, showing a shift in the local property sector. Elsewhere, President Donald Trump protectionist trade measures, including tariffs on semiconductors, autos, and pharmaceuticals, are also raising concerns on global supply chains. Now, for more market moves and views, joining us today is Carl Ashton, investment counselor at Citi Private Bank. Hi, Carl. Welcome to the show.
Thanks, Alex. Nice to be back.
Hi, Carl. Welcome to the show. So let's start with the Singapore stock market, Carl. How did the STI fare today, and did anything surprise you?
Yeah, it was a fairly muted session today with the, as you said before, the Straits Times about 9 points lower. And that's probably one of the tightest ranges that we've seen this year in terms of the difference between the highs and the lows. I thought it was interesting to note there were about 9 stocks that finished up on the day versus 19 that were down. So sort of the winners to losers running at about 2-1 there. And I think probably one of the notable features of the exchange today were just some of those economically exposed names being sold off pretty aggressively. So we saw Zhang Zhejiang shipping coming down around 9%, just on the back of some of those proposed fees that President Trump was looking to impose on China's commercial shipping interests. So that sort of weakening that particular stock, but we did see shipbuilders, particularly the Chinese names, weaker throughout the region as well.
I see. Okay, now let's look at Singapore now. So we've seen some REITs and real estate players reporting a weaker rental income and lower distributions in their latest earnings. How do you see the outlook for REITs moving forward? And do you think these trends will persist, or are there any other opportunities investors should look out for?
Yeah, we're still reasonably constructive on the REIT space. I think if we look at the data center REITs, we thought that they were unduly sold off on the back of the DeepSeek announcement that occurred earlier this month. We're actually of the view that the pace of AI adoption could potentially accelerate cheaper models and or lower costs if that pans out, and that could drive greater demand for the DC space and the capacity providers there. We also recently noted that the take-up for some residential developments in Singapore looked fairly robust. There were a number of residencies which all had fairly strong sales over the last month, and so parts of the residential segment seem to be doing okay. We would be mindful, though, that could potentially result in some cooling measures from the government. And so for us, our preference would be for the asset managers within the residential space rather than the property developers.
I see. Okay. Now, let's take a look at the broader Asian region. So, Asian stocks fell after President Donald Trump's move to curb Chinese investments and proceed with tariffs on Canada and Mexico prompted investors to trim risky bets. Now, Trump proposed tariffs on semiconductors, autos, and pharmaceuticals, which have raised concerns over global supply chains. How much of a ripple effect do you think this will have on Asia, particularly export-heavy economies?
Yeah, it's certainly something that's worth keeping an eye on from investors, and we can already see some corporate reactions taking place. I note that Apple announced overnight that they plan to significantly ramp up investments, both in the US in terms of capex and headcount. So they're looking to spend up to $500 billion and create 20,000 jobs over the next few years. So there is a lot of water to flow under this bridge, though. I think stepping back from globalization is not so easily done, given a lot of companies have invested huge amounts of capital over a long period of time to try and diversify their supply chain. So nearshoring and onshoring is quite costly, and the end result is that the consumer might be the one that actually bears that cost. But I think we will need to see the rubber hit the road, as it were, in that, there's a lot of announcements coming out, but we're actually not sure what the final outcome will be. So between what's actually announced and what actually gets implemented, there's still a lot of distance between that at the moment.
I see. Well, Trump's crackdown on Chinese investments, especially in tech, energy, and other sectors, have made it more complicated. We're seeing Chinese tech stocks under pressure, such as Alibaba, which fell 10% after Trump's directive. So how do you think these markets will navigate this tension between Trump's restrictions and dip buying behavior for Chinese investors?
Yeah, it's an interesting observation. Citi Private Bank's been saying for some time that the coming years will be a lot more volatile. As part of this G2 polarisation theme, portfolio diversification, both between and within asset classes, is one way to insulate against some of the volatility that we expect to happen. And we've noticed also that the US market within the MSCI All World Index is at all-time highs, and the valuations in the US are looking pretty full. So we think that there are other markets out there like Europe and Asia that look attractively valued and have decent earnings growth. So we would expect there to be further opportunities for dip buying in future. I think for the more nimble investors out there, I think there's going to be a lot of opportunities over the next 12 months. But for those that probably more conservative in their outlook, diversification remains the key in terms of weathering, the current environment.
Okay. Well, let's still stay in China. We're already seeing some volatility in Chinese tech shares, particularly Hong Kong-listed stocks, which have fluctuated heavily. And there are also concerns that AI supply chains could be affected if these directives persist. Now, do you think China's upcoming fiscal and monetary initiatives in March will provide clarity and stability on the situation? Or do you think this will continue to weigh on market performance?
Yeah, I think the market's been waiting patiently for the fiscal stimulus to come. If you remember the monetary policy stimuli that were announced in September of last year, so that was the reserve rate requirement cuts, the mortgage relief for homeowners and property investors, and some favourable financing arrangements for brokerages, all of those were targeted at credit supply. What we've been waiting for since September, though, is for the fiscal side to come through, which would address the credit demand side of the equation. And that hasn't been forthcoming. It's been a little bit more piecemeal and ad hoc. So, we're looking for the market's expecting something big from the Chinese government to come in March. And as I said, that's going to revolve around additional fiscal policies to get the credit demand situation running. But again, we'll just have to wait and see what they announce. It would need to be something big because the government's indicated that they would be inclined to raise their deficit spending to around 4% of GDP. So certainly the firepower is there, but we've just got to wait to see what happens. I guess the Chinese government's also been keeping some of their powder dry, just given some of the uncertainty around the trade policies that are being implemented by Trump at the moment.
Okay, well, we're going to move over to Korea now. Markets have also been reacting to Bank of Korea's rate cut to 2.75%, a move aimed at supporting an economy facing slower growth and trade uncertainties. Now, with its 2025 growth forecast now lowered to 1.5%, do you think this signals a broader shift in regional monetary policy? And can we expect central banks in Asia following suit?
The short answer is yes. It does seem that Korea is making sure there is ample liquidity to combat the political turmoil that it's suffering, both at home and abroad. And I thought it was interesting today in the press conference where the Bank of Korea unanimously decided to cut rates, that Governor Ri said that market expectations for an additional 2 to 3 cuts this year were in line with their views. And that's the first time that the Bank of Korea has actually given some longer-term guidance to the market. And they also specifically mentioned that trade policies by Trump were one of the factors behind their lower GDP forecasts. Economic data in Korea around spending and construction and consumer confidence have been weakening of late, hence the Bank of Korea's decision to ease up monetary conditions. I think other central banks within the region are going to follow suit. I think they'll be keeping a close eye on Trump's policies and how that impacts domestic growth. And if they feel the need, then both monetary policy and fiscal policy will need to be implemented.
Well, before we let you go, Carl, aside from this, is there anything else you'll be looking out for the rest of the week? Which are you most looking forward to?
Yeah, there's probably 2 things on the horizon coming up a bit later in the week. So on the macro side, we have the Personal Consumption Expenditures Index, or the PCE, being delivered on Thursday, and this is widely considered to be the Fed Reserve's favoured measure of inflation. So it's going to be closely watched by the market, which is expecting that year-on-year target for PCE to come from around 2.8% down to 2.6%. And then on the corporate front, we have earnings coming from NVIDIA, which is after market tomorrow. So rightly or wrongly, the market would be paying very close attention to this tech bellwether and focusing on comments around the ramp-up of its Blackwell chip, but also to see whether or not gross margins are holding up as well. So we've got some economic data and some company-specific data to look forward to, which will likely lead us into the weekend.
I see. Well, thank you so much for joining us today, Carl.
Thanks for having me on the show, Alex. Always a pleasure.
That was Carl Ashton, investment counselor at Citi Private Bank. This has been Market View on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.